Hi everyone, I'm James. Netflix's latest earnings report tells two completely different stories. One story says Netflix is becoming a mature media company with slower growth ahead and a lower valuation multiple. The other says Netflix is still in the early stage of a much larger opportunity with years of profitable growth ahead. What's interesting is that both sides are looking at the same earnings report. So rather than just reviewing the numbers, let's examine these two competing narratives and what they mean for Netflix's future valuation. First, the headline numbers. Revenue increased 13.4% year over year. Netflix is still growing at a healthy double-digit rate, although growth have moderated from the 15% plus levels delivered over the previous years. Operating margin was 33.4%, broadly in line with last year's level. Looking ahead, management maintained its 2026 guidance, expecting revenue growth of 13 to 14% and an operating margin of around 31.5%, roughly 2 percentage points higher than 2025. So the numbers do not suggest a business in decline, but they do raise a bigger question. Is Netflix transitioning from a high-growth company into a more mature business? Let's start with the market's narrative. This narrative does not argue Netflix is a bad business. In fact, Netflix is one of the most profitable companies in entertainment. The question is whether these best growth years are behind it. The first concern is growth. Revenue growth has slowed from above 15% to the low teens. If this trend continues, some investors believe Netflix could eventually become a single-digit growth company, closer to a traditional media business. The second concern is transparency. Over the past few years, Netflix has changed how it reports operating metrics. The company stopped reporting quarterly subscriber additions, arguing that revenue and profitability are better measures of business performance. It also announced that its What We Watch engagement report will move from twice yearly to annually. Management says this allows investors to focus on the financial results, but some investors see a different possibility. When a company reduces the frequency of a key operating metric, is it because that metric is becoming less important or less impressive? This leads to the next question. If subscriber growth is slowing, where does the next phase of growth come from? Advertising is often mentioned as a new growth driver, but today it remains a relatively small part of Netflix revenue. Meanwhile, some popular shows have experienced lower viewership in later seasons, raising concerns about whether engagement can continue supporting growth. Then there are acquisitions. Netflix made a serious bid for Warner Bros. Discovery, although it ultimately withdrew after Paramount submitted a higher offer. For some investors, this raises another question. If Netflix still has significant organic growth ahead, why pursue major acquisitions? The concern is that Netflix may need new sources of growth as streaming matures. How about the management narrative? They see the situation very differently. The argument is simple. Netflix is not a mature media company defending its past success. It is still building the next phase of growth. The first clue is what management focuses on. Netflix rarely talks about subscribers anymore. Instead, it highlights revenue, operating margins, and free cash flow. The reason? Subscribers are an input. The economic value created from those subscribers is the output, and those numbers remain strong. For 2026, management expects revenue growth of 13 to 14% and operating margin of around 31.5%. The second argument is market opportunity. Management believes Netflix is still early in its growth journey. The company estimates it has reached less than 45% of its addressable household. It captures only around 7% of the global TV revenue opportunity, and it represents just 5% of global TV viewing time. The message is clear. Netflix has not reached maturity. It has only captured a fraction of the opportunity. The third argument is engagement. Critics point to declining viewership for some shows after the first season, but management argues there's no evidence of a structural decline. Total viewing hours increased 2% this quarter. And importantly, not all viewing hours are created equal. Live events are a good example. They represent only around 5% of content spending and 1% of viewing hours. But they have been highly effective in attracting new members. 6 of Netflix's top 10 sign-up days over the past 5 years came from live events. Kid contents tell a similar story. It represents around 5% of spending but generates 8% of viewing hours. The broader strategy is to expand engagement through original content, live events, podcasts, and cloud gaming. Netflix is not just trying to create more shows, it's trying to become a broader entertainment platform. Finally, management addressed acquisitions. Netflix continued to describe itself as a builder, not a buyer. Its philosophy has remained consistent. Create great content, build technology, understand the audience. Management believes acquisitions are not required to drive growth, and any major deal will need to meet a very high strategic bar. So the real question is not whether Netflix is a good business. It clearly is. The question is, what type of business is Netflix becoming? At around 20 times forward earnings, Netflix is no longer valued like a hyper-growth company it was several years ago. But it is also not valued like a traditional declining media company. Everything depends on which narrative you believe. If Netflix becomes more like Disney or Comcast, with growth slowing towards single digits, then even a 20 times earnings multiple may prove too high. But if management is right, and Netflix can continue growing through pricing power, advertising, expanding engagement, and improving margins, then the current valuation could look reasonable. Ultimately, the Netflix debate is not about whether the company will survive. It is about whether investors are valuing Netflix as a mature media company or as a global entertainment platform that still got years of growth ahead. I hope this is useful for you. Stay focused, everyone. I'll see you next time.